Hello, metals and markets listeners out there. Today is Friday, September 14th, 2018. I'm your host, James Anderson of SD Bullion. And this week, we'll do a curated tour of some recent notable commentaries and choice media coverages, a decade since the 2008 collapse of Lehman Brothers. We'll also cover some trial balloons in the financial media in regards to responses for the next recession. As for the precious metals this week, gold and silver have mostly traded sideways and appear to be closing their week trading flat or down slightly. Gold spot price in US dollar terms is closing just under $1,200 an ounce, whereas silver is right near the $14 an ounce level. Although still nominally priced well above their 2008 price lows, gold and silver are now the cheapest they have ever been throughout this full fiat currency era when one uses 1980 methodologies of measuring inflation, the way in which the US government officials used to measure inflation before they started consistently rigging the data to underreport price increase levels. In other words, physical precious metal insurance remains relatively cheap versus other asset classes at the moment. Speaking of which, in a few short weeks, this all-time low price premium offer will end. This week, if you have consumed any mainstream financial press, chances are you might have felt like you were wading through a myriad of half-truths and oversimplifications as to how the 2008 financial crisis came about. Like everyone listening to this podcast, I myself have my own experiences, worldviews, and biases. But instead of just letting the lapdog financial media get in all their talking points without any rebuttals, I figured I would present a curated coverage of this daunting subject matter for the record. My hunch is that the vast majority of you lived through the 2008 financial crisis and have probably studied it since. So I'll just cut to my curation and commentary. But first, fair warning. Much like 9/11 2001, this subject matter can produce triggered rants, political, racial, and tribal-like belligerency. I purposely sourced many critics from the left side of the political spectrum to illustrate how much many of our likely mostly conservative audience has in common. At a minimum, in knowing a truly capitalist system we did away with long ago. We began with CNBC, who interviewed one enabler of the 2008 financial crisis, plus two other fellow overseers of the multi-trillion-dollar bank and financial bailouts that followed. First, you'll hear a stumbling Freudian slip by Hank Paulson, followed by former Federal Reserve head Ben Bernanke shuffling away large portions of the blame and backlash that have surely somewhat obstructed his path since.
How could we explain what we were doing was for Wall Street and not, that it wasn't for Wall Street and that it was for the American people? And it is very, very hard to explain that the system was so complex, so interconnected, that we had to go to the source. And Wall Street was like the heart. And we had to stop, we had to go to the heart, we had to go to the source to stop the bleeding. Otherwise, it was going to kill the economy. And what we were doing is we were putting the TARP, the things we did was like putting a tourniquet on it. But it's very hard to explain that finance is the lifeblood of the economy. And we tried to, all of us stood up there. Ben did something on 60 Minutes. Tim talked about it all the time. I tried to explain that, that if you want to take money out of your ATM, if you want a loan to send your kids to college, whatever, you need finance. But it's a hard case to make, and we are unable to make it.
Chairman? I think the premise of your question is somehow that the current dissatisfaction, populism, the remaining obvious economic problems that there are all traceable back to the financial crisis. I think that's a wrong premise. Financial crisis didn't help, obviously. We know historically that financial crises do tend to precede increases in populist politics. But people have been saying that the country's been going in the wrong direction for 40 years. There's been a long period of very slow gains in real wages, increasing inequality, slow upward mobility, social mobility. We've had rising concerns about trade, China's entry to the WTO in 2002, immigration, cultural issues. So there's a whole gamut of things that are feeding into the popular mood. I think the financial crisis obviously exacerbated that, but it was not, I don't think, the primary source of the politics that we're seeing today. Now,
the former head of the Federal Reserve cited the past 40 years of the nation having been headed in the wrong direction, but many might argue that current problems we face today trace their roots much further back in time. You could cite your litany of reasons if you like in the comments section below, but a few monetary and financial history dates I could give you just to help kickstart that process. From gold and silver being explicitly cited as money in the U.S. Constitution, Article 1, Section 10, to the late 1800s when silver was demonetized and many average citizens in the West were foreclosed on by gold-holding financiers in the East. Or in 1913 when the Federal Reserve and income taxation were simultaneously enacted, which have since spawned a dramatic and consistent currency devaluation of the U.S. dollar, and for average citizens, seemingly ever-increasing taxation. Perhaps the 1933 gold confiscation, where average citizens were forbade from holding over 5 ounces of gold, and forced to turn their private gold holdings for only $20.67 into the Federal Reserve, only to have the U.S. dollar then devalued months later by some 70% to gold. Or perhaps onwards to the withdrawals of silver from coins in 1964, or President Nixon's ushering in of the full fiat currency era in August of 1971, when he had all but closed the final ties of gold to the U.S. dollar's value. Moving along to Bill Clinton's late 20th century repeal of the 1933 Glass-Steagall Act, which used to lawfully segregate large commercial banks from gambling with depositor funds. Only 9 years following that law's repeal, Wall Street imploded and took the world economy with it. Of course, all along the way, there have been many citizens who protested and resisted these events. Some of these persons run one of the best online criticisms of Wall Street shenanigans and complex white-collar criminality. Their website is wallstreetonparade.com. One of the purveyors is named Pam Martins. She worked on Wall Street for 21 years. The final decade of her career, she was an outspoken critic of Wall Street's corrupt practices, including its privately run justice system. Here is Pam Martins in 1998 testifying to the Federal Reserve against the repeal of the Glass-Steagall Act, which one could argue is perhaps leading to a somewhat Japanization of our current U.S. financial system.
It was just 60 years ago that 4,835 of America's banks went broke and closed their doors, leaving shareholders and depositors destitute. The underlying reason that this happened was the lack of moral courage by our regulators and elected representatives to just say no to powerful moneyed interests. Instead of just saying no, Washington handed the banks the equivalent of an ATM card to the Fed's discount window to speculate in stocks. At a time when Japan, the second largest industrialized nation, is reliving the 1930s in America, complete with banking insolvency, it is amazing and preposterous that we should be discussing rolling back Glass-Steagall. We also want to remember that the political dynamics that created the backdrop for the banking meltdown in the 30s grew from a corrupt, cozy culture between Wall Street and Washington. U.S. Supreme Court Justice William O. Douglas, who knew a thing or two about the matter, having just served as chairman of the young new SEC before he went to the Supreme Court, he called it what it was: chicanery and corruption. Frank Vanderlip, coincidentally, an actual former president of National City Bank, wrote in the Saturday Evening Post at the time that lax separation of banking and securities contributed to the stock market losing 90%. I'd like to repeat that, 90% of its value from 1929 to 1933. The public was so sickened by the hubris and corruption that an entire generation stayed away from the stock market. It was not until 1954, 25 years later, that Wall Street once again reached the level it had set in 1929.
Quickly retouching on the potential further Japanization of the U.S. stock market, both Pam Martins and her husband Russ this week covered on their website various trial balloon stories in the financial arena floating the idea that the Federal Reserve should have the legal option to buy stocks outright in the next financial crisis. Of course, Japan, Switzerland, and other government wealth funds are already heavily trading stocks. Many would argue the Fed is also doing likewise through proxies. But the idea of the Fed doubling its over $4 trillion US balance sheet to buy equities was explicitly covered by two sources, of which I will link in the show notes below. As for commodity markets, it's public record that the CME Group incentivizes central banks to actively trade commodity markets, where often majority price discoveries for various raw goods, energies, and precious metals take place. A link to that document will also be in the show notes as well. Turning our attention to how many average citizens currently think about the financial system, and more specifically, the results of the 2008 financial crisis, Democrat Elizabeth Warren breaks down in 2 minutes how many people think about the trillions in bailouts and their resulting outcomes.
So the way I see this, though, is it really is. You do have to do this in kind of the good and the bad. The good is the entire worldwide economy did not go crashing ultimately off a cliff, and we're not back in the Stone Age, which I remember the moments when some people thought that was exactly where we were headed. But the bad news is we put in place a structure that, by and large, sent a message to the biggest guys on Wall Street, and that is, if you're big and you take on risks and it all blows up in your face, you get backed up by the American taxpayer. And here's the key part. There is no personal responsibility for you. None of these bankers, no matter what they were engaged in, no matter what the fraud was, no matter what the deception was, no matter how much failure to disclose or failure to abide by the rules there was, every single one of them, to the extent penalties were paid, they were paid by the company. And everybody learned the lesson. And watch how that lesson played out with Wells Fargo. They get caught breaking the law, right? Just plain old-fashioned breaking the law. And what do? They pay a fine, sign some promises, and break it again. Get caught, break the law again, get caught, break the law again. How many cycles are we on right now with Wells Fargo? Again, without anybody ever being held responsible. And if you don't have accountability in a capitalist system, then the whole thing breaks down. Because it truly does mean these guys get all the profits on the upside and shift all the risks to someone else on the downside.
Popular journalist Matt Taibbi covered the financial crisis heavily since 2008. He was recently triggered with feelings of anger after again writing on this 10th year anniversary of the financial crisis. I will backlink his latest pieces in the show notes as well. To more easily frame the sheer magnitude and scale of the 2008 market intervention and financial crisis, Matt cites in a recent Rolling Stones piece that since 9/11, the war on terror has cost the USA about $6 trillion. Listeners might also cite unaccounted for multi-trillions missing by the Pentagon over the same time frame. Yet also the 2008 financial bailouts were estimated to be as high as $29 trillion in total. Of course, this comparison of the two events and fallouts to follow somewhat trivializes larger losses of life in the Middle East, especially compared to the latter. But one can easily argue both episodes have shaken our culture and its faith in virtually every institution, once perhaps thought better than they are now. Here's Matt Taibbi speaking about his experiences covering the financial crisis on Joe Rogan's popular podcast earlier this year.
You get compared to him a lot, and one way I really saw that comparison was your brilliant coverage of the financial crisis and what was the mechanisms behind the scene of the financial crisis. And that I became a really big fan of your work reading that, because I think you covered that as well, if not better than anybody.
Oh, well, thanks. Yeah, I mean, so I knew nothing about I couldn't even balance my checkbook when they assigned me to that story, and I had to start basically from square one, and I was calling people and saying things like, can you tell me something about something that I'll understand? I was cold calling investment banks and literally saying that. And I finally got a guy to have lunch with me, and he said, your problem is that you're trying to understand this as an economic story. Once you look at it as a crime story, you'll get it. And from that point forward, I felt like I started to understand the whole mechanism, the subprime mortgage scam. It really was a scam. It's really just a massive corporatized version of like selling oregano as weed. Basically, they took stuff that these incredibly worthless, highly risky mortgage loans, right? They would give out loans to everybody with a pulse. Whether you had a job or not, whether you were a citizen or not, didn't matter. Important thing was to get the loan, immediately sell it off, chop it up, turn it into securities, and then they used this highly advanced sort of mathematical trick to turn all that sort of mortgage hamburger into AAA rated securities. So you'd have like a junk rated mortgage, like the riskiest loan in existence, something that was so toxic that companies like Countrywide wouldn't want to hold on to it for more than a week because they were afraid the stuff would blow up. And then they would sell it off to like a pension fund or an insurance company in the form of a AAA rated security, which is as safe as a U.S. Treasury bond. So it was a scam. Again, the metaphor of baby powder, taking baby powder and selling it as Coke or whatever. That's exactly what it was. They just took worthless shit and sold it as something that was gold. And they did it for years and years and years and years. And they knew that this gigantic, huge bubble of risk and disaster was just accumulating, and that someday it was going to all explode and cascade and ruin the economy. But everybody was trying to time it right and bet on when that would happen and make their money before that judgment day came. And it was fascinating. Once I started to learn about it, it was just such an amazingly disgusting, fascinating story that it was just hard not to get into it.
A crime story.
Yeah.
Think of it as a crime story.
Yeah. No. Absolutely. Yeah, and then he probably got ripped off twice because his tax dollars went to go bail out the guys who because some of the banks got stuck holding some of this shit, and rather than eat the losses like your friend did, they got the Federal Reserve to buy it from them, or the Treasury.
And how the fuck did they get away with giving the CEOs bonuses
during that time?
Yeah,
I mean,
giant bonuses during the time where they had to be bailed out by the taxpayers.
Yeah, that was another scam. So there were. If you looked at the fine print of all the bailouts, it basically said that you had to repay the money by X time before you could start paying people exorbitant amounts of money again. But a lot of those conditions were never really followed, and the conditions of repayment were kind of glossed over, and the companies that they were supposed to be able to pass these things called stress tests, which demonstrated that they were back on solid footing again before they paid people bonuses, but the stress tests were all fudged, and there was crime and corruption and illegality basically in every direction during that whole period, and not just in the government but in all of these companies as well.
Jesus.
Yeah, but fascinating to follow.
Yeah, what was it like covering that? I mean, how long did you spend working on that?
7 years probably.
Jesus Christ.
Yeah, well, because one of the things that I found out that was really interesting was, I did my first story about this, and I got this incredible reaction because it turns out that the financial press, there is nobody in the financial press who writes for ordinary people. Like, it's basically what I was doing was a translation job. I was trying to basically take what had happened and explain it in a way that a person who knew nothing about finance would be able to understand. And it turns out that nobody's doing that. So all these people who had questions about it, who wanted to know what had happened to their money, or why did my house get foreclosed on, or what's a subprime mortgage, or anything, There was nobody else doing that work, so I had lots of it to do, and it was really interesting, and I just kept doing it.
Speaking of mainstream financial press, you can perhaps get no higher a seat in that arena than John Authers of the Financial Times in London. He wrote a recent article citing his very own experience during the Lehman Brothers collapse, in which he admits now to have not fully covered key details of the size and scope. I will read direct from his article in his own words. This was a run on the bank. The solvency of Wall Street's biggest banks was in question. Amid chaos, the yields on Treasury bills fell to its lowest since Pearl Harbor. Desperate people needed safety. Interest rates did not matter. Unlike 2007's run on Northern Rock in the UK, none of this was visible. Queues do not form around the block to buy T-bills, but Wall Streeters I spoke to thought the banking system was at risk of failing. As it happened, I had a lot of cash in my bank account at Citibank. I was above the limit covered by U.S. deposit insurance. So if Citi went bust, a once inconceivable event that I could now imagine, I would lose money for good. At lunch hour, I headed to Citi, planning to take half my money and put it into an account at the Chase branch next door. That would double the money I had insured. We were in Midtown Manhattan, surrounded by investment banking offices. At Citi, I found a long queue, all well-dressed Wall Streeters. They were doing the same as me. Next door, Chase was also full of anxious-looking bankers. Once I reached the relationship officer, who was great, she told me that she and her opposite number at Chase had agreed a plan of action. I need not open an account at another bank. Using bullet points, she asked if I was married and had children. Then she opened accounts for each of my children in trust and a joint account with my wife. In just a few minutes, I had quadrupled my deposit insurance coverage. I was now exposed to Uncle Sam, not Citi. With a smile, she told me she had been doing this all morning. Neither she nor her friend at Chase had ever had a request to do this until that week. I was finding it a little hard to breathe. There was a bank run happening in New York's financial district. The people panicking were the Wall Streeters who best understood what was going on. All I needed was to get a photographer to take a few shots of the well-dressed bankers queuing for their money and write a caption explaining it. We did not do this. Such a story on the FT's front page might have been enough to push the system over the edge. Our readers went unwarned, and the system went without that final prod into panic. Was this the right call? I think so. All our competitors also shunned any photos of Manhattan bank branches. The right to free speech does not give us right to shout fire in a crowded cinema. There was the risk of a fire, and we might have lit the spark by shouting about it. A few weeks later, the deposit protection limit was raised from $100,000 to $250,000 via an emergency economic stabilization bill passed by Congress. The problem now is that disposing of that risk has obstructed the task of reducing other risks. Now risks lie in bloated asset prices, levered investments, and in pension funds that hold them. The next crisis will not be about banking, but the insidious danger that pension funds deflate, leaving a generation without enough money to retire. In this article, John Authers fails to mention anything about current bank bail-in legislation signed into law by the largest G20 nations. This legislation was enacted in late 2014, I believe, and it basically makes holders of bank accounts larger than $250,000 on the hook as unsecured creditors if another large commercial bank somehow fails again. The final point I'd like to make before ending this week's podcast is by studying mainstream financial media talking points this week, one can already hear the chorus and the warnings about the next financial crisis being larger than just the banks. Now being called into question is the future strength of the US dollar with increasingly rising debts and unfunded liability levels. I'm not saying the US dollar is going to crash tomorrow. It may actually strengthen further in the short to medium term, which is good news for those looking to acquire precious metals at lower prices. What I am saying, though, is that the world at large faces a present and future likely full of unpayable debts and promises made. My expectation is in the coming years, many promises made will go undelivered upon, or at the very least, heavily devalued. Now is likely a good time to be acquiring assets currently out of favor. Thanks for watching. We'll see you next week.